Hello, everyone, and welcome to the Traders Mindchat show. Today, we will be discussing model stocks, particularly the run that Netflix had between 2022, May of 2022, and today. The big reason why it's important to study model stocks of the past is so that way we could be prepared for them today and capture them in the future. They set up these patterns repeat and they repeat over and over again. So it's important to study the past so that way we're ready for when they set up again in the future. Not only that, in studying the model stocks of the past, you get a much better sense of the types of moves that they've had. So when you go and you analyze this trade, and you'll see it in Netflix, you'll see the types of moves that it had, how long of a run it typically has before it starts to peter out, and then the types of signs that it tends to give when it's getting ready to end its move. Understanding how that works in a stock that you're trading is unbelievable, and it's so important, and it's one of those exercises that I think that too often go neglected, which is why I want to share that with you today. But before we get into that, I just want to let you guys know that last week I was on IBD Live, and Mike Webster talked up the trading mind wheel. I couldn't be more humbled by the great things that Mike Webster had to say about this book, saying that if you love O'Neill and if you love Jesse Livermore, then you're going to love the Trading Mind Wheel. Well, the people that were watching IBD Live, they went and they cleaned out Amazon, and it was sold out for about a week. Well, Amazon is finally restocking their shelves. So if you still want to get a hold, if you don't have the Trading Mind Wheel yet and you want to get a copy, you could head over to Amazon right now. Just scan the QR code there on the screen, and they have more in stock. So let's head on over to the charts, and let's take a look at Amazon. Not Amazon, I'm sorry, Netflix. All right, so here is Netflix, and the tool that I'm using for this whole exercise, this whole model book exercise, is Deep View. The reason why I like to use Deep View, number one, is because it has the charts are very similar to the same kind of charts that we would see in TradingView, some of the best charts around. But also the way that you're able to lay out the lists and all the fundamentals on the screen, it makes it very, very convenient to see some of those kinds of things here. So when I'm doing a model stock review, the first thing that I like to do is I like to start out on the weekly time frame. And so you can see down here that this run from about 2022, right around here in actually it's September, October of 22 through today. Let's just measure that move and see, well, how far has Netflix run in the past couple of years? Netflix has run almost 330% since 2022, October of 2022. That's a pretty nice chunk of change there, isn't it? So the question that I have is, well, what were some of the ways that this could have been traded? What would it have been simple to just buy here and hold? Well, it's actually a question that is going to be different from one person to the next to the next. The way that I go about answering this question of doing this model stock review, I'm doing it through the lens of my trading business plan. My trading business plan has all of the setups that I'm interested in. And so I start here on a weekly chart, and here are the various areas where I would want to be buying it, right? So I outlined a consolidation down here, then over here in May of 23, and I've also labeled how far the moves ran a while before they topped out. So back in 22, it ran 32% before consolidating. Then over here in May of 23, it ran almost 37% before consolidating, and so on and so forth. I feel as though uh, when we measure the length of the move, it's something that can be very useful to us later on, because if we get into the habit of outlining these model stocks, and even the ones that we're in, right? So let's say that you're in some other name right now. If you go and you do this kind of exercise for the entire run, that gives you a much better insight into, okay, here's how the stock moves, here's how it consolidates, here's about how far it runs before it starts to top out. And just in that, that's giving you tons and tons of great insights. So as we're going through this, I want you guys to ask lots of questions. And if you do have questions, just go and put them into the chat. I'll be monitoring the chat throughout this. But let's continue here. So I've highlighted each of the runs that Netflix has had. So it had one over here. It had another one over here in 24, January of 24. Then uh, based on what I trade, the next one that would be buyable wasn't until September of 24, and then that ran 32%. And then there was this latest one right here where it ran about 6% so far. Well, we'll see what happens with that. But and I start out marking all the stuff on a weekly chart. And then after that, I drop down to a daily chart. And when I'm doing these annotations uh, in deep view, most of the time it defaults to letting you take this annotation and put it on every single time frame. Depending on what application you're using, you might need to copy and paste it or check a box. This one has it set up for you automatically. So when I zoom back out and I come over to here to the daily chart, all the stuff from the weekly is already here. And I've already taken some time to annotate some other stuff that I observed on the daily time frames. So we'll start down here with that first breakout that I mentioned in October of 2022. Now, when I come down to the daily time frame, one of the things that I noticed right away is, you know what? I wouldn't be trading this one down here. And the reason why, there's actually two big reasons. The first reason is because it's not in a stage 2 uptrend. I want any stock that I'm going to trade to be in a stage 2 uptrend. What's that mean? That means that price is already above the 50-day and the 200-day moving average. And both of those moving averages are in uptrends themselves. In this case, the 200-day moving average is still coming down, and price was trading below it. So not a stage 2 uptrend. So I wouldn't have been buying there to begin with. But also, I wouldn't have been buying this base because it was right before earnings, and then price gapped out of it. You don't really see that on the weekly chart, and that this is why having multiple time frames up is so helpful. We're doing a real-time multi-time frame analysis. So you see over here, this is a weekly bar, and it looks like, oh, well, price just came right out of there. Well, actually, it didn't. It gapped out of there, and so that's part of what makes this not tradable. It's good to have these kinds of perspectives when we're going and analyzing everything. So we get the full picture of the move, and then we could go down and start to see, how might I have actually traded it? And again, I'll mention this too. How I'm trading this, or how I might have traded it, might differ from how you would trade it, and that's perfectly okay. What you want to do is take the bones of this exercise and then you fill in the meat, because doing a model book exercise like this is going to open so many doors for you. It's going to train your mindset. It's going to train your eyes to spot these things as they're developing in real time, and even manage your trades better. So let's move on to the next bit over here. And again, as you guys have questions, I see more people hopping on. Welcome everybody. You guys over on X and YouTube, and I see some people over on Twitch. Welcome everybody. As you have questions, please go ahead and type them into the chat, and I'll be monitoring the chat throughout the entire presentation here. So this whole move, I wouldn't be trading this until we get over to this section here. Now, this is when price broke out in May of 2023. And one of the things that I noticed was that, you know what, this cup with handle that it looked like on the weekly chart where I outlined this and there was that flat base area, this actually on the daily time frame looks a lot like a VCP. If you're familiar with Mark Minervini's work, a VCP means volatility contraction pattern, where you have this one contraction here, then you have another contraction over here, and then you have that last contraction over here, and then price is able to break out of it. Well, because we started on the weekly chart and saw that price was consolidating in this zone right here, that zone lasted between the end of March to the middle of May, and that length of time means that, yeah, when price is finally ready to break out of this thing, it has the potential to do so in a big way. And it's easy to spot, like we mentioned on the weekly chart. Here's the weekly chart again. And it's also easy to spot down here on the daily time frame. So this is an ideal time to be buying it. So I go in and I see, well, what are some of the things that we could see on this? So over here, it was a first stage VCP, meaning that this is the first base since it's been in a stage 2 uptrend. Great. It broke out on heavy volume. Look at that volume on that breakout. That's sensational. It's the heaviest volume since it reported earnings back here. And before that, you have to go all the way back to January. This is May to find that kind of heavy duty volume. Great. So volume is through the roof. The 5, the 10, and the 21 EMAs are all very close together here on the breakout. On my chart, it's a gray line, the green line, and the purple line. They're all bunched up together, and they're all starting to turn up. That's just something over time that I've observed in my trades, that it tends to be a positive thing when I see them all bunched together and they're all starting to turn up together. It's showing that the trend is changing across short term and even getting into the intermediate term move. Great. And then, of course, the 10-week line was supporting the weekly low. And again, this points to multi-time frame analysis. We've got the 5, the 10, and the 21 supporting the lows over here. And then on the weekly chart, we've got the 10-week line supporting it there too. So there's multi-time frame confluences building on this chart, right? So as you're doing this kind of exercise and as you're making these kind of notes, those things that you're observing will start to register themselves in the back of your mind, even with you just observing them, starting to write it down. You're doing yourself a favor. You're building that mental muscle, so that way when you see this stuff break out again in the future, you'll say, hey, you know what? I've seen that before. Where did I see that before? And if you track it in something like this, in a deep view or some other charting platform, then you're actually able to go and go back to the chart and see, oh yeah, that's where I saw it. And here's some of the notes that I made. So this thing progresses and then it tightens up. It has a 6-day pullback here where it just goes sideways and then it breaks out again. And this was actually a legitimate add-on buy point over here for a couple of different reasons. The first reason has to do with it being that sideways consolidation for 6 days. Well, when it goes sideways for 6 days, that's one of the things that tells me that this could be an add-on buy point. Another thing is the volume. Take a look at the volume down here. Volume is dramatically lower on the down days than the up days. And that's something that we want to be mindful of too. That the low volume that's coming in, the high volume that's going out. That's one of the things that tells us that, hey, this stock is being accumulated. And so that would be a spot to add on. Lastly, this breakout. Oh, I wanted to mention this too. And it's also true here as well, that this last consolidation here, very tight areas, 5% between where you might enter and where you might stop yourself out if you're wrong. We want the tight consolidation zones because that's what's helping us build the risk side of the equation. There's two sides of the equation, the risk and the reward. We want to keep the risk as small as we possibly can. And so when we look at the chart and we find very tight areas of consolidation like this, where everything is all pointing to that one area, that's where the low risk, high reward opportunities are. And so, well, we got one on that breakout. We got one on this breakout. Price starts to move. And then over here, right, that this just happens to be the top. So I start to look at that top and I start to think, well, what about that area right up here? What potential sell signals are there, right? Because we've got the benefit of hindsight, right? So with the benefit of hindsight, going back in time, what sell signals were there at this particular point back here in June of 2023? Well, from when the run started, which was back here, we've already made about 4 times our risk that's just from the add-on. From right here, we made about 4 times our risk. Also, the moving averages are all fanned out. You remember how I mentioned that it was a good sign when the moving averages were all nice and tight? Well, up here, they're all fanned out. You have the 5 over here, you have the 10 over here, the 21 is way down there. So when they're all fanned out like that, it means that there's not a lot of support. So if price does pull back, there's not a lot that's going to push it right back up right away. It only has some momentum. And at this point, price has already run from here, price has run 30%. So it's a good time to start thinking about taking something off the table. Prices are extended, sell something. Great. So you sell something. Then price pulls back, and it pulls back to the 21-day exponential moving average. Now, for me, I don't know about you, but for me, this is another add-on opportunity. One of the things that I look for are pullbacks to key moving averages. And it's not just any old pullback. In this case, price is pulling back in a very orderly way. Volume is low on the pullback. So it's a sign that you had that strong initial run. Volume is very heavy on the accumulation side. Stocks don't go up forever. When it starts to pull back, volume is low. So it's not as though there's a ton of people that are unloading shares here. When it gets to the 21 EMA, you're able to get in with very tight risk on this one. Again, remember, we're always looking at the risk side of the equation, and we also want to take a look at the potential reward side of the equation too. Well, we're able to calculate what the risk is and have a definitive number for that, but the reward side, that's always, well, a potential number. So at this point, the risk side is just 3%. So that's very tight. That's good to be able to say, you know what, if price does bounce off of the 21 EMA, I only have to risk 3% to do that test. Well, you do that test and price runs 12%. And it runs into earnings. Now, over here, right, here's some other notes. Add on 7-day pullback to the 21 EMA. Okay, we said that. Earnings is just 3 weeks away. So it's good to know when earnings is coming up. And then we're able to prepare for a pre-earnings move, because oftentimes, stocks will move ahead of earnings. And when they do move ahead of earnings like this, oftentimes they'll get sold after earnings. When price pulls back ahead of earnings, sometimes it's the catalyst that sends it higher. But in this case, if price ran up, pulled back. All right, fine. So at this point up here, we're extended ahead of earnings. That ends up being a sell signal, right? You might say, well, how would you have known that price was going to fall there? You don't know, but you're able to measure the prior moves. In this case, price had already run 30, almost 37%. And we're able to go in and analyze all the moves that Netflix has when it comes out of its bases. It typically has a move of anywhere between 30, 35% or so. So it's towards the end of that. So, and with price being extended, it actually turns out to be a pretty good time to sell. And so price falls after earnings and it goes back and it doesn't base again in a pattern that I would be interested in until way over here in January of 24. Now, when we're looking at this base here, I have it labeled as not tradable pre-earnings. Again, this is another one that on the weekly chart, it's like, yeah, wow, you would be buying right here. Well, you drop down to the daily time frame and it's actually not tradable. If you don't have a position here, it's not like you bought way back when and now you're holding it forever. But if you're just looking to start a position here, you wouldn't be starting it right there because you don't have any cushion. It didn't break out. It broke out after earnings. And so here's the gap up after earnings. After earnings, it's actually very choppy. It breaks out, it goes sideways, it pulls back, and then it moves and it moves about, you get about three times your risk after this. 2 to 3 times your risk. That not bad, not great. One of the things about this, right? Remember, well, we started to measure how far does Netflix move after it breaks out. The answer that we got from doing this historical look back was that after a strong consolidation, it typically moves about 30, 35%. So we don't want to say 30 to 35% from here. We want to measure from the breakout. So that's going to get us to about here. That's going to get you for if you're buying the gap up and you're starting a position here, well, you could expect to have about a 12% run. Maybe that's okay for you, right? If you're just trading based off of R multiples and you've got this here, well, you might be able to make 2, 3 times your risk. That might be okay depending on who you are. But this was a fairly choppy move. That was not an easy way to make a buck. Then price consolidates some more, and it consolidates some more, and it finally consolidates again way over here. Now here's another one that's not really tradable, right? This one, here's what this one looked like on the weekly. That's right in here. That's the earnings move. So again, this one here on the daily time frame, that's not tradable. The moving averages get all fanned out. It's all very choppy. This one here is a mess. So that's one of the reasons why when you're doing these model stock reviews, you want to use multiple time frames. You want to use weekly time frames. You want to drop down to a daily time frame and see how the action actually was. This one ahead of earnings pulls back. Ahead of earnings, no cushion, no trade. You wouldn't be buying there. Then, what did I say before about earnings? When price pulls back, it can generally act as a catalyst to push you out under the right circumstances. Here, that worked. So you get the earnings gap. then price moves sideways, and then you get a very nice run here. Let me reset the chart and we'll take a closer look at that move. Right, so here we are. We get the earnings gap. We get a 3-week consolidation post that earnings gap. That gives the moving averages time to play catch up. And all the moving averages over here, you see how the 5, the 10, and the 21 EMAs, they're all fanned out in that way. Well, you go sideways for 3 weeks and it gives the moving averages time to play catch up. And now they're all supporting the lows of that move. So if price were to break out and then it fails, well, at least there would be some cushion down there, or some other things that might be able to catch it. If price were to roll over, somebody that's waiting for a pullback to the 10 EMA or a pullback to the 21 EMA, they may be the ones to step in and buy. And that's how you start to see the dip buying that happens, like say over here, where price fell to the 10 EMA and then rallied. I like to have those kinds of things happen when I'm buying breakouts, and how I have all those moving averages supporting the where I would be looking to place my stop. I would place my stop down here, and it's already supported by all the moving averages. Does that make sense? I hope it does. If you've got questions, put them into the chat. If you've got comments, put them into the chat. Let me know that you're alive. Put that into the chat. I haven't seen too many comments roll in yet, but there are more people watching, so hopefully this is making a lot of sense for you all. So you get this consolidation. It breaks out. What else do we see? The relative strength is near highs and strong volume action, right? So where's the relative strength line? It's right here. So the relative strength line is near the 52-week highs. And not only that, you have the same kind of volume coming in. Heavy duty volume on those bars. Look at the down bars versus the up bars, the blues. The blues have the heavier volume on them. That's a sign of accumulation in this name. It breaks out, nice clean breakout, and it goes similar to that first stage one that we saw earlier. Price has a very nice run. It gets to 23% over here, and then it starts to fade. Well, if we measure from the true breakout, which was back here, right? That's the base. This is like an add-on area. The run, that run was 32%. So when it starts to get up here and we start to see momentum failing, then that will be a sign to sell. And how do we know that momentum is beginning to fail over here? Well, we know that momentum is starting to fail in a couple of different ways. The first way is just simply looking at the price action itself. Look at how steep the price action is over here, and then how it starts to level off over here. That's a sign of momentum that's starting to fade. You could also take a look at the moving averages. Look at the slope of the moving averages over here versus over here. They start to flatten out. Here's another way. You can take a look at the stochastics. The stochastics are a momentum indicator. When they start to roll over, and even though they're still up here, if we expand this a little bit, you can see that the fast goes below the slow, and then they start to roll over in this area. So that's a sign of a loss of momentum. So all reasons to sell. And not only that, your main reason is that you've already got a 23% gain from when you got in over here. It's had a run of about 30% from its consolidation back here. Yeah, it's about time to sell. That's when Netflix has shown that it tends to be the end of its move. Then we've got this over here. So price consolidates, it pulls back, has another earnings gap, and it starts to break out over here. Now, I actually bought this one right in here. I bought that. It had this nice little move, and then it starts to pull back. Now the market is wonky. So I'm asking myself, well, gee, what do I know from what Netflix has done in the past? Well, one of the things is that the moving averages are a little wide over here. Another thing that I know is that we're kind of late in its run. If I'm taking a look at all the work that I did before, it's like, well, gee, this thing consolidated 5 times already, and it hasn't reset its base. So how much more room is there left in this thing? Do I want to sit and hold, or do I want to exit with a little bit since the market is a little bit wonky right here, and then maybe look to re-enter later on? The decision is yours, and it all depends on your style and how you play. But hopefully you could see how worthwhile doing an exercise like this is, because you really get a feel for the name. You really get a feel for the stock. Now, all in all, this exercise took me about an hour to do. It's taken me about half an hour to talk you through it. It's worth doing this for any stock that you're holding. It's worth doing this for building your own model book, because you're going to be able to train your eyes. You're going to be able to train your mindset for what the stocks that you're looking at, what they tend to do, how they tend to look like, how they tend to feel, well, what real accumulation looks like, what real distribution looks like, how things start to stall out. It's going to give you lots and lots of really great insights here. So I hope that that was helpful for you. We just had a much larger discussion about this in our accelerator group earlier this morning. We had a small group of us hop on Google Meet, and we went through Netflix, and we went through a couple of other ones, and we got to dig into these names as a group. So if you're interested in joining our accelerator, I just put another QR code on the screen. Just scan that QR code, and if you're interested, I'll see you in there. All right. So that's all I have for you for today. I hope that you found this session helpful. If you did, please drop a comment down below. I read all the comments, and I'll see you guys here next week. Take care. Much love. And as always, God bless.
Hey, thanks so much for sticking around to the end. If you're new here, hit the subscribe button down below and become a part of the Mara Wealth community. And make sure that you check out some of the other videos on the channel. They're exactly what you need to see. And leave a comment down below. I read all of them. Leave a comment.